Hello. Thanks for joining me today. This is my first presentation in the Perspective series, and today we're going to be talking about bear markets. You can expect the presentation to last just under 10 minutes. Today we won't have the opportunity for live questions, but please feel free to send in your thoughts, observations, and questions at the end of the presentation. So, today's agenda. We're in a bear market now. This is typically when stocks fall about 20% from their previous highs, which in this case was in mid-February. Investors are asking, how long will this last for? While we don't obviously have a crystal ball to determine exactly when it may end, John Reckenthaler of Morningstar recently wrote about the 4 stages of a bear market: recognition, panic, stabilization, and anticipation. We've added this analysis to our framework here, and then we can see where we are in this process. So let's take a look about what's going to happen next, both the short term and in the longer term, and we'll conclude with some strategies that we can think about for your investments. Historically, we see bear markets last from about 6 months to 2 years. Other than the Great Depression in the 1920s. The time to recovery to reach the previous market highs can be as little as 10 months for shorter bear markets, or as long as 3 to 4 years, depending on how far and how fast the ensuing bull market will run. Stage 1. It's hard to recognize a bear market. Almost everybody shrugs off the initial slide as being an ordinary event. The markets rise and they fall, and treating every bad week like the start of a bear market would be hard on the nerves. The current bear market achieved stage 1 in mid-March. Stocks were up for the year before, suddenly dropping 11% in the last week of February. They stabilized briefly before falling deeply into bear market territory during the week of March the 16th. Stage 2, panic. Along with the pain and the regret of unexpected losses, investors' faith is tested, and those who don't stick to a long-term plan are found wanting. They sell first and ask questions later. This is the panic selling. We've gone through this, and while it may not have hit the final bottom yet, we may already be moving to stage 3. As with 1987 stock market crash, the current market decline saw the S&P TSX Composite Index in Canada and the American S&P 500 down about 35% from their peak in mid-February. This was the fastest stock market decline since the Great Depression. It is difficult to apply rational analysis when so much happens so quickly. This is why this is the panic stage. Stabilization. This is when the stocks halt their decline, thereby ending the indication that they will do nothing else but fall. The panic subsides, but the situation remains grim. This period is marked by turbulence, and we may be getting to this stage quickly. Stocks will rise rapidly off the bottom, only to fall again and test their previous lows. And as the flood of bad news starts coming in, we're seeing this play right now. Look at the last week of March and into April. Markets moved up significantly, to the point where some in the financial press were saying the bear market was already over, but that's clearly not the case. Anticipation. This is when the stocks start their recovery. As with the bear market's beginning, almost nobody recognizes the end until after the fact. The news at the time tends to be almost unrelentingly grim. However, some investors will see economic improvement distantly in the future, and they will start to buy. As a result, equities will begin to rise in value. And at the time, in March 2009, no one would have thought that we'd be staring at one of the most profitable bull markets in the history of the markets, but that's exactly what happened. We had a very sudden drop in the markets. As we noted, it was the fastest drop since the 1920s. What we don't know is how long it will last. Let's look at other bear markets, though, for some perspective. As we said in the beginning, they can last anywhere from as little as 6 months to as long as a couple of years. We do think this one could be shorter than that, but the truth is we really don't know for sure. When will it end? I'm getting this question a lot. We saw the bounce and subsequent fall several times through the 2008 and 2009 bear market. Don't be surprised when we see this played out multiple times in the coming weeks. This is normal. This is typically a bear market's longest period. So, what's going to happen next? Well, short term, markets will keep balancing the bad news and the good news and the ongoing spread of the virus with the slew of economic and financial measures brought forward by the governments and central banks across the world. These are designed to help cushion the blow of the economic downturn caused by our social distancing and shutdowns, so this will be volatile. When the market finally does stabilize, it's more likely to be due on the news of the spread of the virus finally slowing than due to a government or central bank response. Looking longer term, though, markets have experienced and endured bear markets in the past. The COVID-19 issue will eventually be resolved. And while bear markets and economic downturns are difficult, investing in a diversified portfolio and maintaining the discipline to stick with your longer term plan throughout these periods of volatility are among the key to investment. So, what are some strategies that we can act on? What can we be doing right now in this time where we don't feel like we have a lot of control as to what's going on? Well, first of all, let's review the plan that we've developed for you. We're going to stay diversified. We always want to make sure we've built in downside protection into the portfolios. And for some of you, it might be applicable in your non-registered accounts to have some strategic, what we call tax loss harvesting. It's taking advantage of the down in the market to plan for future taxable capital gains. Continue with your regular investment deposits. This averages down the purchase cost, and of course, this will be dependent on your cash flow. Minimize any required withdrawals. And again, though, we do have that cash wedge strategy that we've built in place for nearly retired or retired clients to make sure we don't draw down any losses in the portfolio and plan for occasions such as this. Well, never really planned on a pandemic, but we want to obviously reduce your discretionary spending. And one of the things that you can be doing is we have worked together using this cash flow workbook. I would encourage you to go back and look at what your discretionary spending has been in the past, where it is now. What are your non-discretionary, those must-have items? This will give us a good idea as to what the very base of your income needs are so that we can make sure that we're planning properly for your retirement. If the time is right for you, we can also look at exposing you to a little bit more equity holdings to see if that growth would work for you better in the long term. Again, if you have any questions at all, please feel free to reach out, and I would love to hear your feedback on this. Thanks, and have a great day.